Imagine stepping onto a roller coaster, that first shudder as you ascend, the uncertainty in your stomach as you round a blind curve. Except, in this ride, every twist and turn has the potential to affect your livelihood, your ability to pay the bills, your plans to buy a home, even the amount you pay at the grocery store checkout. Welcome to the economic thrill ride that is the United States in the summer of 2025, where the Federal Reserve, America's central bank and arguably the most influential monetary authority in the world, stands at a pivotal crossroads. Despite mounting political pressure, market anxiety, and shifting global tides, the Fed refuses to lower interest rates. Why is this such a big deal? And what does it really mean for you, for investors, for workers, and for the global economy? The answers are as much about power, credibility, and trust as they are about cold, hard economic data. Let's rewind to set the stage. In June of 2025, the U.S. Federal Reserve, often simply called the Fed, opted to keep its benchmark lending rate unchanged for the fourth consecutive meeting. The rate remains locked in a range between 4.25% and 4.5%. At first glance, this might look like business as usual, just another technical announcement from Washington. But beneath the surface, financial markets are brimming with anxiety, and the debate among economists and politicians is heating up. President Donald Trump, never shy about expressing his opinion, fired a barrage of criticism at Fed Chair Jerome Powell, even going so far as to call him stupid for not slashing rates more aggressively. Trump's logic is simple. He argues that inflation is not the threat it once was, so why not make borrowing cheaper, boosting economic growth just in time for the looming election season? He even joked about appointing himself to the Fed, underscoring just how politically charged these decisions have become. But the Federal Reserve's job is not to bow to political wishes. It is tasked with balancing two often conflicting mandates: keeping prices stable, which means avoiding runaway inflation, and maximizing employment, which means preventing high unemployment. The dilemma facing the Fed is stark. If they cut rates to stimulate growth, they risk unleashing a new wave of inflation, something that can quickly spiral out of control, eroding the value of savings, wages, and investments. On the other hand, if they keep rates steady or even raise them, they may slow the economy further, leading to job losses and stalling business investment. This is the classic central banker's tightrope. Move too fast, and you fall into inflation. Move too slow, and growth grinds to a halt. And this is not just an American story. Central banks around the world are watching closely. The Bank of Japan, known for its ultra-cautious approach, has kept rates at 0.5%. Across the Atlantic, the European Central Bank, the Bank of England, and the Bank of Canada have all trimmed their key rates in 2025. These moves are fueling a global debate. Is the Fed being too conservative, or is it wisely resisting the urge to follow the crowd? Investors are betting that the Fed will eventually be forced to relent, with a probability of around 70% priced in for a rate cut at the next meeting. Every financial headline, every market analyst seems to be asking the same question. Has the Fed lost its nerve, or is it providing the steady hand the world needs? Expert opinions are divided. Diane Swank, chief economist at KPMG, suggests that financial markets are not expecting any movement in rates prior to September. Her view is that patience could ultimately pay off, especially if inflation begins to ease on its own. John Velis of BNY Mellon, however, warns that tariffs could keep inflation expectations stubbornly high, making the Fed's job even more complicated. Meanwhile, market veterans like Michael Feroli at JP Morgan argue that every move the Fed makes will have far-reaching consequences, and that in these conditions, policy mistakes could be more costly than ever. Let's take a moment to consider why the stakes are so high. As of June 2025, the U.S. national debt has soared past $34.6 trillion. Yes, that is $34.6 trillion. Every decision on interest rates affects how much the government pays to service this massive debt. Lower rates mean less interest paid, freeing up resources for other priorities. But if lower rates fuel inflation, the costs could show up elsewhere, at the gas pump, in grocery aisles, and in the form of higher rents and housing prices. But what does all this mean for the everyday American? Let's break it down. When the Federal Reserve sets its key interest rates, it directly influences the rates you pay on credit cards, car loans, student loans, and mortgages. If rates stay high, borrowing becomes more expensive. Imagine trying to buy your first home. A mortgage at 4.5% is significantly more costly over 30 years than one at 3%. Every percentage point adds thousands of dollars to your payments. For businesses, higher rates mean it's more expensive to invest, hire, or expand operations. The ripple effects stretch from Wall Street to Main Street, impacting everything from small business loans to big corporate investments. Now, let's explore the scenarios that could play out as the year unfolds. Scenario 1. The Fed holds its ground and keeps rates steady for the rest of 2025. According to its own forecasts, economic growth could dip to just above 1%. Unemployment may inch upward, possibly reaching 4.5%, as companies pull back on hiring. Stock markets, which thrive on cheap money and investor optimism, could cool off. The effects of President Trump's tariffs would continue to echo through global supply chains, raising costs for American manufacturers and consumers alike. In this situation, patience is the guiding principle, waiting for more data, more clarity, before making a move. But there is an upside to patience. If inflation does begin to ease, the Fed may finally deliver those long-anticipated rate cuts later this year, perhaps 2 modest reductions of 1/4 percentage point each. This would provide a gentle boost to the economy, lift investor sentiment, and possibly revive sluggish hiring. But even this approach carries risks. If the Fed cuts too soon or by too much, it could unleash another round of inflation, quickly erasing the gains for households and businesses. Scenario 2. Stagflation. This is the nightmare scenario for central bankers, a toxic mix of stubbornly high prices and weak growth. Think back to the 1970s, when oil shocks and policy missteps led to years of rising unemployment and soaring inflation. If tariffs and supply disruptions keep pushing prices higher while growth stalls, the Fed faces an agonizing dilemma: raise rates to tame inflation, risking a deeper recession, or lower rates to spur growth and risk letting inflation spiral. As Michael Ferroli put it, the Fed is walking a tightrope. Every move has consequences, and no outcome is certain. Scenario 3. Geopolitical shocks. The world is not short on potential flashpoints. Tensions in the Middle East, particularly between Israel and Iran, could erupt at any moment, sending oil prices skyward. This would make inflation even harder to contain. A sudden spike in energy costs could force the Fed to raise rates abruptly, rattling markets and making life tougher for borrowers. As Powell noted, while energy shocks do not always have lasting effects on inflation, the risks are real and the outcomes unpredictable. To fully appreciate how unusual this moment is, let's look back at history. In the aftermath of the 2008 financial crisis, the Fed slashed rates to near zero, keeping them there for almost a decade to support the recovery. In 2020, when the COVID pandemic hit, the Fed once again acted swiftly, cutting rates and flooding the economy with liquidity. Those moves helped avert a deeper recession, but they also set the stage for the inflation surge of 2021 and 2022, when supply chains were disrupted and demand rebounded faster than expected. Now, the pendulum has swung again. Inflation fears are back, and the Fed is determined not to repeat past mistakes. But there is another layer to this story. Underneath the headlines, the Federal Reserve is also fighting to protect its credibility and independence. Throughout its history, the Fed has faced political pressure, but rarely as overt as now. Critics like President Trump want swift action to juice the economy ahead of an election, but central bank independence is foundational to market stability. By signaling that it will act only on data, not on political demands, Powell and his colleagues are sending a message to the world. The U.S. economy is governed by analysis and prudence, not by tweets or partisan whims. Let's turn now to the international stage. The global economy is more interconnected than ever. When the Fed makes a move, other central banks often adjust their policies in response. In 2025, however, we are seeing divergence. The Bank of Japan is holding rates steady at 0.5%, pursuing its own strategy amid Japan's unique deflationary pressures. The European Central Bank, Bank of England, and Bank of Canada have all chosen to lower rates, seeking to bolster their economies even as the Fed stands firm. This divergence can create volatility in currency markets, affect trade balances, and influence investment flows worldwide. For example, if U.S. rates remain higher than those in Europe or Japan, the dollar may strengthen, making American exports more expensive and potentially widening trade deficits. Financial markets are in a constant state of anticipation. Right now, investors are pricing in a 70% probability that the Fed will lower rates at its next meeting. This expectation shapes everything from stock prices to bond yields, and even the price of gold. The so-called dot plot, which shows where Fed officials expect rates to go in the future, suggests that 2 cuts could be coming before the end of the year. But as history has shown, markets can be fickle. Expectations can shift overnight in response to new data, geopolitical events, or changes in rhetoric from Fed officials. Let's add another layer, the U.S. national debt. At over $34 trillion and counting, every tick upward in interest rates means billions more in interest payments for the federal government. Some policymakers argue that lower rates are needed to keep the cost of servicing this debt manageable, but others warn that using monetary policy to manage government debt is a dangerous path, one that could undermine the Fed's primary goals and fuel future inflation. So, what should ordinary Americans do in this climate of uncertainty? Here are a few practical tips. Second, for those carrying credit card or variable rate debt, review your statements closely. Higher interest rates mean higher monthly payments. If possible, pay down high-cost debt or consider consolidating to fixed-rate loans while rates are still relatively stable. Third, investors should resist the urge to overreact to headlines. Volatility is a fact of life in uncertain times. Diversify your portfolio across asset classes, keep your long-term goals in focus, and remember that timing the market is notoriously difficult. Let's not forget about employment. If the Fed's cautious approach results in slower job growth, workers may face stiffer competition for new roles, fewer raises, and more pressure to upskill or reskill. In this environment, taking steps to boost your qualifications through training, certifications, or networking can help you stay ahead in a changing labor market. Now let's peek into the future and consider a few possible scenarios based on the Fed's options, global events, and unforeseen shocks. First, if the Fed maintains its current stance and inflation proves more persistent than expected, we could see the economy enter a period of sluggish growth and rising unemployment. Stock markets could stagnate, and consumer confidence may weaken. For policymakers, the challenge will be how to support growth without reigniting inflation. Second, if inflation moderates in the coming months, the Fed could pursue a calibrated easing strategy, 2 small rate cuts by year's end. This could boost markets, encourage investment, and give consumers more confidence. But the risk is that the move could be premature, especially if tariff-related price pressures linger, or if wages start to rise faster than productivity. Third, if stagflation takes hold, a combination of high inflation and weak growth, the Fed would be forced into an excruciating balancing act. Raising rates to fight inflation could deepen the slowdown, while lowering them to spur growth could fuel more inflation. This scenario, reminiscent of the 1970s, would test the resolve and creativity of policymakers. Fourth, the wild card, geopolitical shocks. An escalation in the Middle East, a sudden spike in oil prices, or a dramatic shift in global supply chains could force the Fed to act quickly, potentially raising rates to contain inflation, even at the risk of hurting growth. In such scenarios, markets could become highly volatile, and both consumers and businesses would need to brace for rapid changes in costs and borrowing conditions. Through all these possible futures, one thing remains clear: The Federal Reserve's decisions touch every corner of the economy. Whether you are an investor tracking the latest market moves, a business owner planning for the next quarter, or a family budgeting for back-to-school expenses, Fed policy shapes the environment in which you operate. As Esther George, former president of the Kansas City Federal Reserve, wisely put it, steady hands and patience are critical in times of uncertainty. That advice rings truer than ever as the world's most powerful central bank weighs its next move. Here's the bottom line. The Fed's caution may be frustrating, especially when other countries are already lowering rates and trying to jumpstart their economies. But in a world where trade wars, political drama, and global shocks threaten to tip the scales, patience may be the smartest play. By holding steady and refusing to cave to political pressure, Chair Powell and his colleagues are sending a powerful signal to global markets. The United States economy is led by data, by analysis, and by a commitment to stability. So, what do you think? Is the Federal Reserve's patience the right move, or are they risking too much by waiting? Do you think political pressure should play a role in monetary policy, or is independence more important than ever? Let us know your thoughts in the comments below. And if you found this deep dive helpful, don't forget to like, subscribe, and ring the bell so you never miss our explorations into global economics and technology. Thanks for watching, and we look forward to seeing you in the next video.